Retailers like Nike, Lululemon, and Starbucks under pressure as slowing growth in China has weighed on those companies' profit margins. Now, as we head into the thick of earnings season, which names are best positioned to overcome some of that weakness? Joining us now to discuss, we've got John Kernan, TD Cowen, Managing Director of Retail and Consumer Brands. Thanks so much for joining us here, John. I want to start specifically on Nike having a really tough go of it with the consumer weakness that we've seen in China in particular. If you believe that the China story is not changing, how do you believe that there's going to be a recovery in Nike?
Well, we're very cautious on Nike. We have a hold rating and $75 price target, so there could easily be more downside in the stock from here. I think as you look at their China business, they've carved out a leading position in terms of brand preference in athletic footwear and apparel in China. The macro in China is a real issue. Our survey, which was a survey of 2,000 consumers on the ground in China, pointed to real concerns about some of housing prices. They're concerned the demographics in China are some of the worst in the developed world. And Nike has a tough go of it in China from the local-based China competition. Local-based China competition is increasingly scaling. They've added $5 billion in revenue since 2019 between two companies, Li-Ning and ANTA. Nike's revenue is down over $1 billion during that time period. So Nike's in a tough spot from a macro perspective right now.
So how big of a drag do you expect that to continue to be on the stock?
I think investors and analysts need to rein in their expectations for China, both on a top line and margin basis long term. There's a lot of policy headwinds that could happen from here that are unpredictable and unknown. But if our Washington research group is right on some of their concerns about some of the trade policy, you could see a real retaliation from Beijing that could really hurt from a tariff perspective. It could hurt from a demand perspective. That's what we're most concerned on.
Say more about that retaliation. And do you think that retaliation requires a Trump presidency, or do you think that it is going to occur regardless of who ends up in the White House come November?
Seems like a bipartisan issue at this point, although Trump may bring increased rhetoric to the table, but permanent normal trade relations could be removed with China. They would certainly invoke some type of retaliation from Beijing. There's a lot of capital controls that our Washington research group has written and talked about quite a bit. And the retaliation from Beijing and Chinese consumers could be significant. Again, it's an unknown, but it certainly seems like it has higher probability of policy headwinds increasing as we get into 2025.
John, is that a similar argument just in terms of the downside risk that you're making here for Nike? Could you make that for Lululemon, and why or why not?
We are buy rated on Lululemon. I think the stock's valuation is extremely cheap here, but I think one of the real concerns across our report today was how investors would value China-based cash flows. What's the appropriate discount rate? What's the long-term growth rate of companies' businesses in China? There's just so much uncertainty on this right now. Lululemon has an increasing percentage of growth coming from China. They're hosting Investor Day in China in October. So they are strategically very focused on China, and I think it's a concern from a lot of investors given all the issues we just spoke of.
What do you think the potential is for Lululemon to be able to emerge as the retailer that found a way to win in China when you've got Nike, Adidas, Estee Lauder struggling because of pressures in the mainland?
Yeah, sure. Lululemon's business right now is incredibly strong in China. We expect the China-based business to be up nearly 40% year over year this year, on top of very strong growth last year. We think they'll finish around $1.5 billion in revenue by the end of 2024. And they could have a reasonable path to $3 billion plus. So there's going to be tremendous growth in China. Now there's going to be a lot of growth. It's really dependent on how it affects how investors view that growth and what multiple they're willing to pay for that growth.
John, when it comes to brands trying to figure out how to succeed in China, I guess what are the biggest differences just in terms of brands that are resonating with Chinese consumers? What are they doing right? What are some of the key differences that you're noticing when it comes to success in the Chinese market versus what retailers are doing who are succeeding here in the U.S.?
I'm sure the Chinese consumer obviously has different preferences and styles than U.S. consumers. Certainly Nike has carved out a very large and successful business in China. So has Adidas in our sector. Lululemon's the most rapidly growing brand in China among that peer set right now. But some of the concerns lies in how fast some of the local China brands are scaling, particularly Li Ning, Anta, Fila, which is owned by Anta. There's other brands rising. So got to be a little concerned about the rise of the domestic brands in China and their ability to steal market share.
All right, John, we're going to have to leave it there. Thank you so much for joining
Thank
us
you.
this morning. That was John Kernan, TD Cowen's Managing Director of Retail and Consumer Brands.